Hello, friends. Welcome to this Dirty Economics webinar on Bank of Japan preview. So, right off the bat, let me make this clear that Bank of Japan policy review due tomorrow. Uh, uh, like we are just around about 12 hours away from the release, and it's extremely important this time around, and I shall explain why. It has got it will have ramifications across the globe, and that is the reason why we decided to come up with a detailed preview. So let us begin. There's only one slide, and these are the 4 points as you can see on the screen. And if you hear closely, if you hear what I say while explaining each point, you would understand why it's so very important. Why Bank of Japan is even more important than Federal Reserve now. The first, as the heading goes, it's the end, and it's the end for Bank of Japan's maybe 2 decade or 3 decade madness of unconventional monetary policies. Uh, Most of the people know about QE, because of Fed. Fed did QE1, and then the word quantitative easing became famous. But it should be noted that Bank of Japan has been doing such kind of unconventional monetary policies for more than a decade. Interest rates have been very very low for more than a decade. And it's somewhat in some way, Bank of Japan represents the in fact, it set the precedent for other central banks to follow. And it's a sad thing that the precedent that BOJ said is not, it's not positive. And the end of Bank of Japan's, ultra easy madness, should I say, indirectly says that, in the long run, market forces will always win. The forces of demand and supply will always win, and intervention will never work. I know I'm sounding like an Austrian economist, and but that is the truth, because the Keynesian economists believe in intervention, government intervention or central bank intervention. But here is the perfect example, that the Bank of Japan has neared an end. When I say end, it doesn't mean that it would be locked up soon. The end means, it's lost its efficiency, it's lost control over its currency, its monetary policy is a mess. Rates are into the negative, and I find this negative rate concept extremely hopeless, because the idea that interest rates are below zero indirectly tells you that monetary policy is dead. Because how come interest rates could be zero? There's no way. you know and it just represents the mess. And that is the reason, I said it's the end and it's the victory for market forces. So the first point goes is like this: forced normalization. uh, if you have been a dirty economics follower, this over the last few days, or a couple of weeks, Reuters, Bloomberg, and every other analyst is saying, the rising yields, the bond market is steepening, etc., etc. And because of that, yen is under pressure and things like that. But if you are a dirty economics follower, we had discussed this well in advance, at least two months in advance, on various videos, webinars, or even the articles on yen. There is a particular article available on the website, Dirty Economics website, where I specifically mentioned that, eventually bond yields are going to rise, and that would weaken yen, and that would also push bond yields across the globe higher as well, across the advanced world. And that is what is happening. And usually rise in bond yields represents rate hike expectations, high growth, high inflation expectations. However, it's extremely twisted. This time, the the rising yields represent central bank failure. It represents central bank exhaustion, because the rates have been pushed so much into the negative territory. banks are suffering, pension funds are suffering, and there is no borrowing at the same time, and that is the reason why BOJ has now under pressure to do Operation Twist, which means buying less of the long duration bonds, that is buying less of 10-year, 20-year, 30-year bonds, and buying more of 2-year bonds, 1-year bonds, things like short duration bonds. So the net effect would be the yields at the long end of the bond market curve rise, and yields at the short end of the curve drop, leading to a steepening of the bond yield curve. And steepening of the bond yield curve is nothing but policy normalization. So it's a forced policy normalization. It has been forced onto the Bank of Japan because they overdid with their easing and conventional monetary policies. They are being forced now. Market forces are are forcing Bank of Japan to normalize its curve. And note this point, that post 2008 yield curves have flattened, and flattening yield curves have been accompanied by rising equities. Okay, so when the yield curve begins steepening, the opposite should happen. It's just a no-brainer, and many people say that rising long-term yields would be beneficial for banks. Sure, they would be beneficial for bank because bank, borrow short and lend long. So higher rates at the long end would definitely help banks' profitability. But I don't think that single factor would help stocks. BOJ, if it doesn't announce Operation Twist tomorrow, it will have to announce it someday, And when I say someday, it's not 10 years, 15 years down the line. It's maybe in next 1 year or so. The BOJ Operation Twist is being forced on BOJ. It's not by choice. It is being forced, as I just explained. You keep on doing this rate cut QE for so long period of time. They have reached below zero levels, and marginal efficiency is lost completely. And that was quite clear, quite very, very clear after the Jan 29th announcement of negative rates. Yen drops by 200 points, and what happens next? Jan 29th was Friday, I remember, and yen dropped by 200 pips against the dollar, and it resumed its uptrend. So the Jan 29 high stands at around 121.85, if I'm not mistaken, and the Brexit low is 8.79 or something, I guess. So it's just quite clear that the tools have lost efficiency, and now they are being forced by market forces to normalize the policy. And hence, I say in the second point that steepening yield curve means weakness in equities and sliding yen. Many people just say that Japanese debt, it is not owned by foreign investors, it is owned by domestic investors. So rise in yields, it's just not really a threat. I beg to differ on that. They already run such a huge debt to GDP ratio that rising yields in Japan is likely to shift markets' attention to Japan's fiscal position rather than anything else, and that in itself will weaken yen. Even if we ignore this fundamental side of the story, just take into account that since 2008, falling yields have been accompanied by a rise in the Japanese yen. Dollar yen traded at around 130 or so in 2008, and by 2011 September, I guess, it was at 75.57. There's little reason to believe that the steepening yield curve would help yen. If anything, steepening yield curve would definitely help euro, a pound, for that matter, against the antipodes, that is Australian dollar and New Zealand dollar. This is because over the last few months, 3 or 4 months or so, Australian dollar and New Zealand dollar, given the fact that they offer a significantly higher yield compared to their European and Japanese peers, were the major beneficiaries of the falling Fed rate hike bets. And now, if Bank of Japan is being forced to steepen its bond yield curve, this steepening of the bond yield curve would be exported to European nations and US as well. By which I mean to say that the yield curve in Germany, yield curve in France or United Kingdom or United States, Canada, all those advanced nations would also see the yield curve steepen the way they did in the last week or so. And what that would do is that would reverse the flows that hit Australian dollar and New Zealand dollar over the last 3 months. So the ideal trade would be, in case the bond yields at the long end of the curve across the advanced world begin rising once again sharply, then that would bring Aussie dollar and New Zealand dollar under pressure, especially against Japanese yen and Great British Pound, Euro, US dollar, etc. And all this scenario at the end of the day, concentrate on the second point. Steepening of the yield curve means weakness in equities. The higher the equities rally without due to excess liquidity, that is due to unconventional policy measures, the higher is the pain threshold of the central banks to equity market. I'm sorry, the lower is the pain threshold of the central banks to the slide in the equity markets, which means the higher the equities go, the more nervous, the more quickly Fed would become nervous about stock market correction. So we have had an unprecedented rally. So even a minor drop these days, and suddenly Fed rate hike bets drop, simply because the more overstretched the stock market rally is, the more nervous the Fed would become, even if there is a slight correction. Which indirectly takes us to the third point, that for last so many years it has been Federal Reserve or ECB or Bank of Japan that is keeping the equity markets afloat. The last thing anybody wants right now is a deflationary crash, asset price deflation, asset price crash. And note that asset price crash is always deflationary. So the last thing any government right now wants is a deflationary crash. And so all this indirectly opens doors for increased possibility of fiscal stimulus. Eventually we are moving towards fiscal stimulus. The net result is switch to fiscalism. That is a policy where governments start spending on infrastructure projects and things like that, and that help create artificial demand. As we discussed in the last video, I guess, on fiscalism, I would like to reiterate the same point here, that in fiscalism, you create artificial demand in your own economy, and in currency wars, by weakening the currency, you try to steal the foreign demand. You import the demand, and that's why your exports rise. So this is what can happen at the BOJ meeting, tomorrow. I don't see the bank moving rates further into the negative territory. That's just not going to happen. And if they do, they would have to, they would be forced to steepen their yield curve at a much faster rate. And nobody would want to have that, especially with equity markets, threat of a major correction in equity markets. So I guess they would stand pat as far as rates are concerned, and we are likely to see Bank of Japan announce Operation Twist, whereby they would buy less of long duration government bonds and buy more of a short duration government bonds. So what we would now do is, let's take a look at a couple of yen pairs. Let's take a look at a dollar yen. Right now it's trading around 101.67. This is the hourly chart that I have right now, and sorry, 5-minute chart. And let's switch to a wider time frame. This is a bigger time frame. This is a daily chart, and as we can see, it's moving in a downtrend right now. MACD has just switched to negative territory, but it's more or less flatline, and it's quite understandable because there is so much noise about BOJ. Nobody is willing to take risk, and ideally, no one should. But what I would like to show here is the monthly chart, because it's really it's really telling you something, and that is quite possible that uh, their currency may have, their currency pair may have just bottomed out. So this is the trend line that I have just drawn, uh, falling trend line, and so it's from the 1998 high to 2007 high and extended further. If you carefully look at this, the last couple of candles, 3 candles, they have repeatedly found support around the trend line level. And look at the last candlestick; it's a bullish hammer appearing at a critical trend line support, following almost a 2500 pip fall. This entire thing suggests, it tells me that we may have, just the selling has run out of steam, and we could be going higher from here. Another point worth noting is that, check out this blue line, which represents the 50-month moving average. This is the 100-month moving average, and the black line is the 200-month moving average. We are likely to see a bullish crossover between 50-month moving average and 200-month moving average, which in a way is a sort of long-term golden cross. And the stage looks set. Most of the time when these golden crosses appear, prices have already rallied, and so these golden crosses are usually, they're made fun of, that they are Lagarde indicators. And usually when these golden crosses appear, prices have already rallied, and then they lead to a pullback before further rally. But over here the picture just looks set. We have a golden crossover when price is not at its highest in recent years. It has retraced the 50% of the rally from 2011 lows to 2015 high. Now when we look at this rally from 2011 low to 2015 high, it appears a big one, because the pair has rallied from 75 to like 125.856 in June 2015. However, consider, if we look at the historical data, you zoom into your chart. I don't have charts beyond 1997, but you can surely have them on Net Dania, etc. You can check that in 1970s, late 1970s, Japanese yen was trading about 300. And if you drop a Fibonacci retracement from the 1970s decade high to 2011 low, you would come to know that the pair hasn't even retraced 23.6% Fibo. So what that means is, there's still much scope available for a rally if you look at a multi-decade time frame. So this rally from 75 to 125 over the period of 4 years or so, it's just a drop in the ocean, I would say. And overall, the chart tells me that we are likely to go higher from here. Stage looks set. The fundamental situation is aligned perfectly. There's very little the Bank of Japan could do. The only thing, that could push dollar yen lower to maybe 94, 95 levels is an asset price crash. But note what I said. This time you have a correction in stock markets. Governments would come up with fiscal stimulus plans. Mark my words. This is being forced on governments, and I call it a central bank conspiracy. Because even an average person would know that the thing with the QE and interest rates were overdone. And why would a highly qualified economist at central bank would push interest rates to negative territory? What a common man understands, I'm very sure that the central bank chiefs who have studied at Princeton University and the big universities in US and across the globe, they surely understand that the negative rates would never work. But I guess that was the only way to force governments into coming up with fiscal stimulus plans. If you remember, since 2012, this debate has been very hot, that austerity is not working, and the we need stimulus, we need fiscal stimulus. But central government just stayed away from all this debate, and they just avoided, should I say, they just avoided getting enticed by these calls for fiscal stimulus. and hence I call this a conspiracy theory. I believe central banks have purposefully exhausted themselves. I'm not so sure about Bank of Japan, but I am very sure about ECB or other banks across Europe. They have purposefully exhausted themselves, and now now there's a threat of asset price crash. And now the governments know that central banks have nothing left with them. So the only alternative, as I said a few minutes back, nobody wants a deflationary crash right now. So at the end of the day, governments are being forced. So overall, in this, in light of all this situation, I believe dollar yen pair is probably poised to go higher from here. And the immediate target that I look for is 105, 106. At the max, it could go down to monthly 100 MA, which currently stands around 97 levels or so. But anything beyond that, I doubt. I seriously doubt. So that's it for today from me, and I shall catch you later tomorrow after BOJ. Follow us on our website and our Twitter handle, and we'll get updates there as well. Thank you.